Welcome to the Commercial Property Podcast. My name is Suzi Carter. I am a chartered surveyor. I've been involved in commercial property in the UK for 30 years and I've done hundreds of commercial property deals. I'm here to be your guide through the commercial property market, whether you're an experienced investor or whether you're literally thinking about dipping your toe in the world of commercial real estate. I will be here talking to you about all kinds of things commercial real estate in the UK, and I've also got some fantastic guest experts who are joining me. So please do subscribe if you'd like to follow, and if you'd like any more help or information on commercial real estate, please do click www.suzicarter.com, which is my website, and you can find out all the ways I can help you. So stay tuned for this week's episode. I'm here today with Andrew Drakes, and Andrew is an inheritance tax planner who I have used for a lot of the things that I've put in place with my family. So Andrew, welcome.
Thank you. Good to be here.
Great.
On this sort of getting sunnier day, not quite all the way there, but yeah.
Yeah, we're recording this in deepest, darkest January. So if you listen to this in summer, then yeah, we're quite looking forward to those days, I think.
Yeah.
So Andrew, I'll move to your introduction in a minute. I'd love you to introduce yourself to everybody, but I think kind of it's a bit of a preamble why I've arranged this. And obviously, it's a little bit of a different topic today for the Commercial Property Podcast. Usually, I give strategies and talk about commercial, but I think this is so important for any type of investing, whether it's property investing or any type of investing at all, because you definitely need to plan in terms of what's going to happen after your day, but also kind of while you're alive, making sure you've got the most tax efficient structures in place. And I think the lesson that I've learned is the earlier you put this stuff in place, the better, really. And actually the cheaper, I think, as far as life insurance and everything is concerned.
Yep.
So that's what we're going to talk about today. We're going to give the whole world of inheritance tax planning and trust a commercial property and a property spin. But I think for any type of investing, this is going to be super useful for you. So Andrew, thanks so much for being with me. Would you like to do just a quick intro to yourself and your company?
Yep, absolutely. So I work for CTT Group, or I'm a part of CTT Group, Charlie Tango Tango. So we're a firm. There's about 120 of us in-house. We've got IFAs, we've got solicitors, we've got accountants. And how I sort of knit into the mold is I'm the estate planner and also a financial advisor as well. So I have my head in both camps, which is important when you look at inheritance tax. You mentioned there life insurance, which is one option for reducing inheritance tax, or certainly providing cash to pay it. So been in the industry for 12 years. Joined Countrywide as it was. Didn't know anything about wills, I'll be frank. Didn't know anything about estate planning. Just threw my CV at everybody and see what landed. And then went on to our foundation course and effectively fell in love with the concept of estate planning, which from my perspective, to I guess give you a definition of how I see estate planning, it's how you can pass on what you've built in the most efficient manner possible. And that brings with it tax, but also ease of administration after you've passed away. Because if you leave your kids with, a massive inheritance tax liability and you've got commercial property or property and no cash to pay it, well, you're leaving behind a bit of a headache, And as you said, Suzi, the earlier you start, the easier it is to finish, if you will.
Yeah, no, it's a great point. And, when I do direct to vendor marketing campaigns, it's amazing the amount of family of commercial property owners that I speak to who, unfortunately, the parent or the uncle or whoever has passed away, and they have literally no idea. Everything's a total mess.
Yeah.
They don't know how to administer or manage or asset manage commercial property. I was speaking to someone this morning, actually, and they were saying, they don't even know how many properties there are in the portfolio. There's a tax mess. So obviously the aim of the game, I guess, is not to get yourself in that position and make sure that you.
Ideally not. And I guess the added string of complication there as well is if you've got, for instance, a joint venture type scenario where you've got, money all piled in together with business partners, say, well, what the business partners want to happen and what your family members want can also differ. So that just adds a layer of complexity to the issue, really.
Yeah, that is a really great point, actually, because I've got a number of joint ventures, and a shareholders agreement is so important, isn't it, to
Yep.
make sure that everybody understands what happens. I mean, I think I was stuck on one point with some partners for about 6 months because it was literally like, what happens, in that
Yeah,
eventuality. But it's so important to kind of talk about those, have those difficult conversations early on, isn't it? So
I agree. Totally agree.
yeah, great. So, why don't you? I mean, obviously, it's quite topical this because the government is, seems to be quite liking looking at inheritance tax at the moment. So, even more compelling, I think, probably to put this in place. But why don't you kind of start us from the beginning in terms of, if someone comes to you, that they've maybe looking to invest in property or they've got an existing portfolio, kind of where would you usually start?
Okay, so from an inheritance tax point of view, clearly the starting point is, well, what am I liable for? What is my inheritance tax liability going to be when I pass away? And there's clearly a lot of information I need to know to be able to tell you that. So it's a bit of a admittedly laborious fact-finding process of, well, what assets do you own? Have you got a will and all that sort of thing. But then at least it allows me to fairly accurately tell you, if you did nothing today, you left your will as it is, and you left your assets in the ownership that they are, this is the tax liability you've got. And it's that foundation that we can build on, essentially. So it's understanding what the inheritance tax liability is, and again, bringing our commercial property spin onto things here. Where property investors struggle, where perhaps other sorts of businesses don't, is generally speaking, you poor property investing people, you're not afforded any relief from inheritance tax. So if I've got a manufacturing business, for example, there's an amount of relief I can have on that business when I die. But property investment, generally speaking, you don't have that luxury. So you've got a great wealth building business, if you will, but the tax man's going to try and chop a lot of that off. So it's how you can then manage things moving forwards. And really, the starting point for me, it's going to sound a bit corny, to be frank, but if ever you're building a structure, you're a chartered surveyor, it's got to start with the base. You've got to have a good foundation on which to build on. And the foundation is your will, which sounds like an odd thing, because most people would rightly assume that to reduce inheritance tax, I've got to do something today. I've got to give assets away or sell them, whatever it might be. It's a today action. It's a give something away now. But the reality is the will is the most important thing, because there's really only one solution to that, to be as tax efficient as you can be. Whereas when you look at reducing your actual inheritance tax liability, there's so many avenues. So you don't want to get stuck deciding which avenue to take, and then you go away and die, and you've not sorted the will out, So it's always the starting point. And like I said, we don't want to go on too much, but it's just a couple of key points that I always mention from a will perspective that sort of justifies why that's the place to start. And that's looking at your tax-free allowances. So if we assume you've got, a married couple worth £2.5 million, okay, not totally uncommon nowadays. In fact, certainly from my perspective, more common than not. Yeah. And the general stance of what they've got in terms of their estate plan is a will that leaves everything to each other and then on to the kids. So you then say, okay, well, what tax-free allowances have you got? So you've got your nil rate band, which is 325,000. Everybody gets that. And then we introduced the residence nil rate band back in 2017. So there was big hoo-ha, front page of the papers. Everybody's going to have £1 million worth of tax-free allowance. But it's not necessarily the case. So the residence nil rate band, that additional 175 bolt-on that you now get, there's some rules that apply to whether you can claim it. So if we've got a will that leaves everything to the survivor, then when the survivor dies, they're worth £2.5 million. Well, because of that estate value, you've lost £250,000 of tax-free allowance, which translates to an inheritance tax cost of 100 grand. So why is this person paying 100 grand more? Because the will wasn't written correctly. And that's not giving anything away. You're not having to do anything. It's just get the damn will right and you'll be okay. And it's as simple as maximize your tax-free allowance on first death by using a trust. And that would have then taken away all of that additional inheritance tax effectively.
Yeah, great tips there. So so people look at their will with you, they kind of work
Yeah.
out what they do and don't want to do, and then then as you mentioned trust. So talk to us about the different types of trust, because obviously there's like a living business kind of trust, isn't there?
Yeah.
And there's a trust upon death, or first death,
Mm-hmm.
second death, whenever it is. Can you explain to us the difference and when you might kind of recommend either of those or both?
Yeah, I think there's probably a bit of a mystique about trust when there really shouldn't be. Yeah, there are lots of people that say, "Oh, there's 11 million different types of trust that you can have," when in reality, there's really not. So, the most common, from a taxation point of view, you really only have three types of trust. You have a relevant property trust, which is pretty much every lifetime trust you would create.
Mm-hmm.
A qualifying interest in possession trust, which I won't go through, but that has a different type of tax rules that can only be created in the will. And a bare trust, which really isn't a trust at all. That's just me holding a property for you. It's yours for all intents and purposes, So it's really this first trust I mentioned, this discretionary trust, that's the most powerful trust and the one that I use for every single client. And the real benefit to that is the inheritance tax treatment. So if you imagine this trust as a box, so we've got our box here, and whatever you place into it won't then increase the value of your kids' estates. So it's ring fenced. Okay, so we put money in the box. Your kids won't pay inheritance tax on it. Your grandkids won't. Your great grandkids won't. And this trust can be around for 125 years. So you've got 125 years of asset protection of whatever you've decided to put into it. Now, there are lifetime tax issues to consider, which we'll talk about when we're creating a plan. You don't want to set a trust up that's inheritance tax efficient, but going to create all this extra tax in lifetime. It's not what we want to do that. And we'll go through all of that on a call anyway, just so you're sort of well aware of what the situation is. But tax aside, you've got the don't let the tax tail wag the investment dog type scenario. It's not all about the tax. What a trust allows you to do is retain all of the control because you can remain a trustee, reduce your estate's liability for inheritance tax, great. But equally, there's that ongoing protection for your kids and your family. So, consider the outlaw from hell. Your kids get married and divorced. Well, if you created a trust and not just given it to your children, then that trust will protect your estate for 125 years. So the outlaw from hell can remain the outlaw from hell and go elsewhere because you're not taking anything that was once yours. So there's that control element to it. You retain control during your lifetime because you're a trustee. And actually, you retain control after you've died because this trust sets out the rules in which your estate is going to be used for the benefit of your family members, which are grandchildren, children, great-grandchildren, and so on and so forth.
Yeah, perfect. Yeah. And obviously you can put I've been through this process with you, and you can put all the kind of whys and wherefores when the money gets paid out, or and that's a one to think about, actually, kind of just by way of an aside, because I was thinking, okay, I don't want the children to inherit things too early and not understand the value of work. Other people may differ with this view, but that was very strongly my view. So what's the balance in terms of it, meaning they have some money maybe for healthcare or for travel or for education, versus actually actually going out to work and actually kind of properly knuckling down and being productive. And so it definitely raises some quite interesting questions, doesn't it, these kind of trust process?
Yeah, they do. And the interesting thing there, and you'll see this in a lot of wills, certainly I see it a lot, it'll be, well, I leave everything to my kids, but they're only going to have it at 25. Okay, so your kids are going to be sensible at 25 when they're 10 years old.
Oh, I was so sensible at 25. Not.
Yeah, I know what I'd be doing with the money. It wouldn't be here anymore anyway.
Yeah.
So it's taking that not right away from them. But, the trusts sound complex, but they're not. And what you write, as you well know, because this is all been prepared for what you've set up yourself, Suzi, is each of these trusts, you write a personal letter of wishes, which is a really odd thing for me to say, that the most important document is the document you can prepare yourself. It's not a legal document. It's just a wishes letter. It's a guide to the trustees to help basically me get into the mindset of Suzi. What did Suzi want to happen in these different scenarios,
Yeah.
So, yeah.
This episode is brought to you by Bond Finance Limited, your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
So we've talked about the kind of trust on death.
Yep.
So what about kind of living trust, business trusts? When I talk to a lot of property investors, I think there's a lot of confusion around that, and also particularly if you could touch on kind of getting mortgages and how lenders feel about business trusts owning an asset or having a shareholding in an asset. That would be, I think that would be very interesting for people listening.
Yeah, fine. So so in terms of business trust, we're back to this: how many trusts really are there? The business trust is just, frankly, a discretionary trust that owns shares or owns a property or whatever it might be. So structuring these things is important. The lending position isn't the easiest thing to get around, but you can structure it in such a way that the lender becomes not as much of an issue as he should be. So these are the sorts of things we would talk about certainly on a private call. There are ways and means to do certain things. But coming back to business trust, so my sort of interpretation of what a business trust is, it's a trust whereby you're going to gift presumably shares in a business. So coming back to the issue of property investment company that could be worth 1-2 million, whatever it is. You own shares in that company. You don't own the property, you own the shares. And of course, you're going to be subject to inheritance tax on the full value of those shares. So really the purpose of the business trust is to take the shares away from you as a gift, and you gift the shares into that trust. Now, the alternative to that, what a lot of people do, they might just give the shares to the kids. Okay. And quite often they just do this without tax advice. And what you've got to be aware of is a gift of shares or a gift of rental property or a gift of commercial, whatever it might be. It's a trigger event for capital gains tax. So the term I tend to use is you've got an asset pregnant with gain. You give it away, you give birth to the gain effectively, and you've got to pay that tax. So you can't really get around that on a gift between individuals. Okay. And of course, my other issue with gifting it to the kids is, are they sensible? They're going to have full rights and access to the property or the business. And of course, you've lost control at the point you gift it to them because it's now become theirs. So what the trust allows you to do is retain all of the control because you're a trustee. Certainly a lot sunnier your end than it was before.
It's suddenly cloud here. It's really sunny.
If on that plan was a bit bigger, it would shade you off there.
I'm going to have to close the curtain. I think we'll cut this bit out. But yeah, I was thinking, how can I close this curtain without anybody noticing?
It's all good. So yeah, coming back to the gift then. So gifts between individuals, more than likely going to be gifts between yourselves and the children, will be subject to capital gains tax. And you can't avoid that. That's what we call a dry tax charge. You're having to find the tax to pay it, and you're not getting anything in return. With a trust, what you can do is move the shares in. You can defer the capital gain because you can do that on a gift of trust. So you can start moving assets away without paying capital gains tax. And because you remain the trustee, you remain the person in full control. So you've lost no control whatsoever, and you've started eating away at the inheritance tax liability. Now, with more established businesses, what we tend to do with those is effectively draw a line in the sand, because the problem you've got is, let's assume you've got a business worth £1 million and you give away half of that business into trust. 7 years later, your share is worth £1 million. So your liability is the same 7 years later because of how good you are and how much the business has increased in value. So one of the big issues that faces a lot of property investors is the fact that because you're in property, and property, frankly, tends to go one way, you're worth more than you were before I did anything. When we get to that 7 year period that you've got to survive for gifts. So what you can do with these businesses, you can draw a line in the sand and say, right, I'm going to freeze the value of this company now. And then I'm going to create a different class of share, which will take all of the growth away. And it's that growth that can be given away. The beauty of that being that you can control what that liability will be when you die. It's not going to get any worse, essentially. And all the growth has passed away. All right. So for me, a business trust is simply a trust that you're going to use for inheritance tax planning. It's just a straightforward discretionary trust you can't benefit from, but you remain a trustee of it.
Yeah. And am I correct in saying that if you set one of those trusts up, the beneficiaries get the rental income or the dividends from that particular company?
It depends on how you structure it. So you can structure the shares to be alphabet shares. So you wouldn't have to, let's say you give away 10% of the company into trust and you declare a dividend of 100 grand. It can be structured in such a way you wouldn't have to give the £10,000 if you didn't want to. And of course, you probably won't want to do that if you've got minor children, as you have, because you'll just be subject to the tax on the dividend anyway. But yes, in theory, you're right. And it comes back to, I mentioned before, you've got lifetime tax issues to consider for a trust. They're not very tax efficient for income tax and capital gains. So you have to manage them in such a way to take those issues out. And we can set the trust up to essentially give beneficiaries the right to the income. And then essentially the company can pay the income to them directly, bypassing the trust and avoiding any tax returns due in the trust as well. So there's a bit of a perception that trusts are quite admin costly. I don't like to do trust admin, and you don't want to pay me to do trust admin. And generally speaking, there isn't much admin to do on these trusts because they just own the shares. You're not going to liquidate, so there's no capital gains tax issue. And any income just gets paid directly to the individuals.
Yeah.
Where they just sort of sit in the background as silent shareholders, if you will.
Yeah, sounds good. And yeah, so definitely, I mean, this is a complex area, as Andrew's trying to make it as simple as possible, but this is a really complex area. So definitely speak to an expert like Andrew about this and, really get under the skin of it. And I think we've kind of talked so far about assuming that people are, they're investors, they hold on to assets, they let them, they have the rental income. What about if you sell assets or you're flipping assets? Kind of, is there a different way of kind of dealing with assets like that, or should you approach it differently?
Okay, so if we look at a commercial investor or a property investor, as these people tend to have, you often have hands in many different property pies, for want of a better phrase. So you could have a management company, you could have a development company. Yeah. So your management company doesn't own any property; it just manages the rents, and if you've got an Airbnb business, it sorts the cleaners out and whatnot. So the management company is one that could qualify for business relief. We're talking about inheritance tax here, so you've potentially got a company that you won't pay inheritance tax on. Your property development business, so this could be buying a property, developing it, selling it. Use the cash to buy 2 properties, develop, sell. You're a developer. You're not holding on to the properties that you develop. And again, that is or can be classed as a trading activity, hence one that would qualify for business relief. And business relief, again, they've changed the rules, as they will have changed the rules come 2026. That used to be unlimited. So if you had a development business or a manufacturing business worth £10 million, the whole thing could pass through the will free of tax. Now, of course, you've seen all the news about the farmers up in arms and all the rest of it. But it doesn't just affect the farmers. It's any business owner has been affected by the fact that they've reduced the amount of business relief you can have, to £1 million. So effectively, you could have a property development company worth £1 million and pass it on free of inheritance tax. Now, the problem with that is the allowance isn't expected to be transferable between husband and wife. So if we go back to Mr. and Mrs. that I mentioned at the start of the call, they're worth £2.5 million. Suppose they had a trading company worth 2 million and left everything to each other. Then you've wasted that £1 million allowance that was available when Mrs. passed away, or whoever died first, and that would create another 200 grand of tax unnecessarily. So it's really a bit of a use it before you lose it type scenario from a business relief perspective. And I'm also dealing with a client at the moment, and what she's got, and this may or may not apply to your folks, is she's got a holding company essentially, which a lot of these things are sort of prop opco. And the problem you've got with a holding company, or certainly a company structure that holds the trade and the investment activity, is that if the investment activity dominates, then the whole thing sort of falls apart from an inheritance tax point of view. So her situation, who I was talking to yesterday, she's got a lovely marble business, so a lovely trading business that sells marble, furnishes kitchens and whatnot. And then within that, so she got that limited company owned by Holdco up here, which then also owns about £6 million worth of rental property. And you're like, well, come on, I can't, this isn't any relief where you are now. And so sometimes it's a case of we need to restructure things appropriately. So the simple answer for her, we've got to consider the tax, of course, is to demerge, get the trading company out so that it stands on its own 2 feet, and we get an inheritance tax boost on that.
Yeah, it's a great point. And actually, one thing I would say to everybody listening to this is, before you buy anything, speak to accountants, speak to Andrew or someone like Andrew to talk about kind of the structure of how you purchase, because unlike residential buy-to-let, you can buy commercial in your own name. You're not going to get the Section 24 or bigger issues with that. But yes, exactly that trading versus investment issue, it can really stymie you later down the road. So it's almost kind of like you're talking about kind of speaking to a tax accountant, someone like Andrew, a kind of inheritance tax planner, and probably like a pensions expert as well, Andrew, kind of a SAS expert. Or
get everybody into the mix. And SAS is another one come 2027. I think they're going to rob from you. So I totally agree. And at the end of the day, we've got accountants in-house, we've got an IFA firm in-house, but my best introducer is an IFA. So it's not we offer an IFA service, so we're touting for the financial services business. And it's the same from an accountancy point of view. So what often is quite useful is where we get on a call with the accountant. If you've got an accountant for the company, say, right, I'm looking at this from an inheritance tax point of view, and this would be better. He will obviously be looking at it from a lifetime point of view. So sometimes it can feel a bit short-sighted. You're looking at today, not the end, which is where I tend to look at things.
Yeah, no, absolutely. And I think we were talking earlier before we started that start with the end in mind is the best topic. So we're all enthusiastic. We all want to rush in. We want to buy properties, and it's all kind of very sexy and exciting. But actually, if you have to go back and unravel companies and not just for inheritance tax, but for all kinds of tax, actually the same goes for VAT, capital gains tax, income tax. For example, could you buy in your SAS rather than your own name and kind of have the tax advantage of that? So there's always worth that point, isn't it, of pausing, seeing kind of where you want to get to, and then kind of working back from there. And I know that's something that we've always done, and actually as a result of that, I feel like when we're structuring property transactions, sometimes we do it in lots of different ways because we want to we're starting with that end in mind.
Yeah, no, I totally agree. And a couple of things to consider as well. And again, it's just clients I sort of fall into over the years. You might buy. Just think about when you make an investment, you set up an SPV to buy a bit of land somewhere. I don't know. Are you realistically wanting to benefit from that growing value? do you realistically need to benefit from the proceeds, or are you likely to sell and reinvest somewhere else? And this comes back to start with the end in mind. If you don't ever plan on using it yourself, and you're buying it, let's say you're buying it £200,000, and post development that's now £1 million. Well, that's £400,000 of inheritance tax on something you never intended to use for yourself anyway. It was always intended to be for the kids. So when it comes to estate planning and gifting to trust, another sort of comment I'd have is it's always best to gift when it's worth little. Pre-planning permission, pre-house or commercial premises on top or whatever you. So think about the end goal. Do you want to benefit from this company or not? And how I'd imagine a lot of these company purchase or whatever work, Suzi, is often you've got a loan in. You loan money into the company, create your director loan account. So giving away your shares in the company doesn't stop you repaying yourself the loan account. So if you think, well, I don't need any more than that, okay, well, give the company away. It's worth nothing. You've loaned the money in, it's got nothing else. Just give the shares away, because then the growing value is immediately outside. There's no 7-year clock or anything like that.
Great tips there. Really, really great. So, and I think just to stress, like, all of this is totally legal. It's just common sense, because I think certainly this current government, they seem to be gunning for inheritance tax, don't they? There seems to be something they think is less emotional, perhaps, given their pre-election pledges or whatever it might be. But it certainly seems to be viewed as a bit of a low-hanging fruit. So to kind of get onto this as quickly as possible, I presume that would be your advice, Andrew. I don't want to put words in your mouth, but I presume that would be your advice.
Absolutely, get onto it as soon as possible. And actually, surprisingly or not, that it has been a catalyst. Like farmers coming forward, left, right, and centre. People are actively trying to deal with it. The pension side of things probably wasn't as much of a surprise to me as the business relief thing was. You've got trading companies here that are now going to have to find millions of pounds when they pass away that they didn't have to previously. So, but it is what it is. You can only plan with what you've got. And like you say, start early is the best time to start. And just a quick mention, I don't know how long we've got, Suzi, but just a quick mention on the life insurance side point you made. Life cover is available to cover your inheritance tax liability. And it's cheaper the younger you are. I don't tend to call it life insurance. It's the best savings plan because you will always get out more than what you put in, unless you're planning to live to 120, which most people aren't, I would imagine.
Be nice, wouldn't it?
Yeah, indeed. I actually went to a similar to yours, I guess, it's about 30 property letters in a room, like a round table. And I stood there and basically told them that you're my most painful client because it's much more difficult to deal with property. And life insurance is the first thing you should consider. And none of them had heard of it. Not one person in the room had heard of whole of life policies. And that's the holy grail to me, because it's going to take time to sort the inheritance tax out. There's no easy and instant fix. And what you've got to consider, what you've got to ask yourself is, A, if we use the kids as an example, are they capable of managing this when they pass? And B, how are you going to fund the inheritance tax? Where's the money coming from? And it's a really weird thing when it comes to probate. So probate's the process of, Suzi's passed away. Here's an inventory of her assets and liabilities. Get me the grant of probate so I can start selling assets that I need to. You can't get the grant of probate until you've paid the tax. You can't sell assets until you've got the grant of probate, so you end up in this, well, where do I go from here? So yeah, life insurance just gives you that cash injection to either pay all of the bill or some of it to allow the executors to take the grant and move forwards. And these things are made no easier with business partners in the mix as well.
Yeah, no, great tips there. Fantastic. Good stuff. So yeah, I think kind of the overriding message from today is, if you haven't thought about any of this stuff, I would say from different angles, actually. Number one is it just makes sense, speaking to accountants and tax planners, to talk about how you're structuring your purchases anyway. You don't always assume that a limited company is the best thing to buy commercial in. There might be other reasons why you might want to buy in your own name. So for example, you might have capital allowances. You might have capital gains tax in your own name, which might mean that if you can claim capital allowances on a property you own in your own name, you might be able to offset that. So it's very tailored, isn't it, Andrew, to kind of your own situation. Obviously, in inheritance tax planning is so important. It's one of those things we all think we're going to live forever, but actually, sadly, we don't. It always makes me feel very slightly uncomfortable when Andrew starts talking about me passing away, but it's fine. I'll let that go. So. Andrew, how can people get hold of you? And are you happy for people from this podcast to kind of get in touch and kind of have a intro chat to you?
Yeah, so I'm assuming we had to put some notes on the podcast anyway. But best two options of getting me: either call me directly 01926 514 390, or email me, which is Andrew D for Delta. So Andrew D at ctt-group.co.uk. So Charlie Tango -group.co.uk. Aim to get back to you within sort of 48 hours. And if you sort of mention this podcast or use the promo code CPA intro, then there's a no expense first meeting. So, just come and have a chat. We'll talk through things. Generally speaking, I believe I can help people, but there is no charge to come and talk to me. And hopefully after this, you want to come talk to me. Some people might not, but we'll have a sensible conversation, talk about options, and then we'll come back to you on an email with this is what we think you should do. These are the sorts of charges you're looking at. And then it's over to you. So it's a sort of no commitment first chat, really.
Perfect. Thanks, Andrew. Yeah, definitely use that CPA intro code, which we'll put in the show notes as well, so that you've got that, and also all of Andrew's details, so you can get in touch with Andrew. And hopefully this has really kind of put a light bulb on for a few people, kind of made you realise the importance of kind of starting with the end in mind and making sure that you structure things properly. So Andrew, thank you so much for spending some time with us.
No problem. It's been my pleasure. Thank you for having me. Although you might not have me again if I keep talking about you dying and things like that.
No, definitely not. No.
You can't take that away.
Thanks, Andrew.
All right. Lovely speaking to you.